In this video, I'm going to demonstrate joint cost allocation using the net realizable value and physical quantities method and using exercise 1148 and 49 as an example. We have here a company that manufactures 4 different grades of lubricant from a joint process. So as part of that joint process, they get these 4 unique products, W10, W20, W30, and W40. And they indicate that the total joint costs are $384,000. So we have to determine a reasonable way to allocate to the different products for purposes of both financial statement purposes, to value the inventory on the balance sheet if there's any, and also to value cost of goods sold on the income statement, and also for pricing decisions. Now, there's a couple different approaches we can use. One's the net realizable value method, and the other is the physical quantities method. The net realizable value method allocates the joint cost based on the relative sales value at the split off point. And we can see here they indicate the sales value at the split off. Split off is just a point at which, from that joint process, at which we can identify these unique products. So I'm going to jump down to W20 and go ahead and allocate the amount of joint cost to it. Based upon net realizable value, W20 has a sales value at the split off of $288,000 relative to the combined sale at the split off for all products of $960,000. So if I take $288,000 divided by $960,000 and then multiply that times the joint cost of $384,000, I'm going to allocate out of that $384,000, $115,200 to product W20. One benefit of the net realizable value method is that the gross profit margin is going to be consistent amongst all the different products because you're allocating costs based upon the relative sales value. One thing I will note is we can only do the net realizable value method if we know the sales value at the split off point. If you normally don't sell the items at the split off when we can uniquely identify them, and you typically always continue processing and sell it at a later point. If you don't have that information at the sales value at the split off point, you can also use the estimated net realizable value method. The estimated value method would be based upon taking the sales value of processing further minus the additional cost. Again, sales value of processing further minus the additional cost, because I want to say there's an incremental cost of processing further. And again, take that relative to all the different products. And the reason why is if I don't have the sales value at the split off, but I do have it at the point of processing further, I can at least utilize that information. Another equally opportune way to allocate the joint cost is the physical quantities method. And like the name says, it's purely based upon the amount of production or some type of quantity. So for product W20, we're going to measure physical quantity based upon the number of units produced. For example, W20, there's 40,000 units produced relative to production overall for products of 160,000. 40,000 divided by 160,000 would be 25%. Also times the 384,000 equals 96,000 of the 384,000 allocated to W20. We can determine here that it's going to be very different depending upon which method that we utilize. Unrelated to this particular problem, but I want to mention because it may be a nuance. What if there had been a byproduct? Again, not a core part of this problem, but what if there had been a byproduct? For example, when I worked for Kimball Industries, one of the things they had at the time, they owned different forest land in order to get trees, raw material for lumber for their furniture. Well, a byproduct might have been the bark. Hey, it wasn't an intended part of it. It wasn't something you can necessarily use as the furniture, but how am I going to deal with that in terms of costing? There's a couple different options to deal with any revenue that you earn or net value that you earn from the byproduct. And one is to subtract that from the joint cost. That's one of the two approaches. So I'm going to demonstrate that. Just for comparison, again, I'm going to say if we had used net realizable value For W20, again, 288,000 divided by 960,000 times the 384,000 is 115,200. But if we have the byproduct and choose to reduce the value that we can sell the byproduct from the joint cost, we still take the 288,000, 960,000. But now we multiply it times 374,000 because we're subtracting the 10,000 from the 384,000 in joint costs, and we're only allocating 112,200 to W20 if we compensate for the byproduct.